In this short video, we would like to explain to you the two main principles or styles of investing in this country. They are active management or passive management, and it's very important that you're aware of these two so that you can choose wisely. First, we must define those two management styles. The first, passive, is where the investment manager takes a long-term view, avoids subjective forecasts of the markets, and aims to deliver market-like returns. An active manager attempts to beat the market or benchmarks. And the way they do that is in two different ways. The first way is market timing. Market timers attempt to predict the future and therefore future share prices and place a bet on your behalf. Now, we don't believe, as many people do, that anybody yet has accurately and reliably predicted the future. And therefore, the overwhelming evidence suggests that market timing is a losing proposition. The other problem with market timing is that the market has a tendency to have very large bursts of gains and losses in a short number of trading days. Now, if you miss those short number of trading days, you make a massive impact into the returns you get, as the following evidence shows. This evidence is over a 40-year period and shows how much money you can lose by missing just the odd day or two along that time scales. So if we agree that it's impossible to predict the future, why take that risk? In fact, Hal Heaton of Brigham Young University has investigated and found that only 5% of investors, and those include professional investors, have beaten the market over a 5-year period. Make that 10 years and only 0.1% have beaten the market. We again feel that's a losing proposition, something he suggests is more akin to chance. The other active management style used to attempt to beat the market is share selection, and that involves the fund manager finding shares that they feel are incorrectly priced and, of course, placing another bet with your money that they will correct themselves in your favour. We believe, however, that the markets have all the information needed to accurately price a share. In fact, on the odd occasion that we'll admit share prices can have the odd error, they're so random and unpredictable, again, it's just not worth taking the risk. In fact, if you've got information that the rest of the market doesn't have, that's called insider trading, and you're likely to go to jail. Now, if you think those two things are bad, wait till you add the extra cost required for an active way of investing rather than a passive way of investing. We would suggest that throwing darts at the Financial Times will give returns comparable to that by most fund managers. Throw in the extra costs, you'd be better off with the darts. And just so you don't feel that's a throwaway comment, here's the evidence. Look at these charts over 3, 5 and 10 years to show how often fund managers don't beat the marketplace. It's a very compelling piece of evidence. So this is why we strongly believe that the passive style of investing is one that will benefit you rather than the active one, which tends to benefit the industry. You need to retain as much wealth as possible so that you can enjoy life and achieve your life goals and objectives sooner rather than later.